We're going to see a bit of strength in the US dollar, but we don't see this as a game changer. Clearly, the market is slightly disappointed. They expect, they wanted a more dovish cut, and this is not what we got. The messaging suggested that we're very much in a mid-cycle decrease in interest rates. But for now, the economy continues to be relatively robust in the US. We are mindful that we've seen some recessionary indicators turn more cautious. Two of them, the yield curve, that's been very well debated, and then the ISM new orders minus inventories series, which also shows more caution going forward. But we are still telling our clients it's worth being fully invested. So we have a market weight on the US and on global equities. But we're mindful that things will start becoming a bit more complicated over the next few months, and it'll be time to be more defensive then.
I mean, one of the interesting debates of the last few weeks is really been this sort of rotation from growth into value. How do you see this being impacted? Because generally, value tends to do well when the market becomes more optimistic about the economic recovery.
Yes, so the mean reversal has been absolutely ferocious. Our sector strategy in the US is a barbell strategy. So we have exposure to more defensive sectors, consumer staples, utilities. So those have been subject to some sell-off recently, but we still think that they should do relatively well compared to the overall market. They're high yielding. This is a factor that tends to do well when interest rates come down. And they are not exposed to trade war threats or the threat of the presidential election next year. So on one side, exposure to defensive sectors, and on the other side, exposure to more cyclical sectors. And there, the banking sector is particularly cheap. It's particularly well capitalized. It gives a dividend, and there's some buybacks. So the total yield can be north of 7%. That's an attractive value proposition for us, and we are very intrigued by the industrial sector. So the industrial sector clearly has really suffered and is suffering from the trade war, but valuations are starting to be really distressed, and we think that looking forward, if the clouds of the trade war dissipate somewhat, we don't think they'll dissipate completely, but if they dissipate somewhat, this sector could do relatively well. So barbell.
Oh, I'm so sorry. Nice to see you, Frederique. Do you really believe in absolute terms, or is this all about a relative trade? Because you mentioned consumer staples, so I just picked out one of the biggest names as well, and it was a random one. It is Procter & Gamble, and it trades at 4 times forward, 24 times earnings. Now, at the start of the century, I could buy that for about 8 or 9. It's got a 2.5% dividend yield. Again, you say they're high yielding. I mean, yes, it's higher than treasuries, but is it high yielding? So I've got questions about whether you really like these companies or you're just forced to like them because the alternatives are so bad.
So you need to put your money somewhere, and it's a relative call. A lot of consumer staple companies pay dividend, they also grow dividend. And over time, these companies tend to do well. So we do want to have exposure there.
Why won't I see some form of reversion to a lower historic PE on these kind of names? If I'm paying 24 times forward for something, I would normally historically have liked to see huge growth potential. It's because they've got a massive China angle, or it's like a luxury goods sector in the old days or something. Now I'm paying 24 times for something that's probably growing at between 2 and 4% revenue like for like on an annual basis. I'm less excited at paying those kind of multiples.
That's maybe the example of P&G. They are consumer staple companies which can grow faster than that, and it's the consistency in earnings growth.
You tend to pay a lot more though for those.
It is more expensive.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.